I'm Neeraj Shah, and we've chosen an important but a simple topic today, or simple but an important topic today. What should a mutual fund investor do now that the equity markets are trading at life highs? It's very tempting to put profits at the very same time. It's very tempting to stay invested as well because you never know for how long the party will last. But as most people say that when you're investing in funds, invest for the long term. Vijay Mantri certainly loves to say that, and he joins in right now to talk about what could possibly a mutual fund investor do at these levels. Vijay, great having you. Thanks for taking the time out. A lot of people might be feeling shaky about the fact that we've rallied quite a bit. India is trading at expensive valuations. Mid caps and small caps have rallied quite hot as well, and most fund managers saying they find it difficult to find value at the current levels. So is it good to book profits? Is it good to stay invested, or is it good to add? Why? And of course, the why along with each of these.
So first of all, good afternoon and very warm welcome to you, your team, and all the viewers of BQ. In one question, I think you asked so many questions,
I
so
know.
I'll try to attempt answer at least few of them, and perhaps whatever I could not answer, perhaps there could be supplementary questions or same question can be answered. So it is very important to look at the market from a valuation perspective and why the current market are at these level and what one could learn from what happened in past, maybe 2008, maybe 2000, maybe 1992, and why investors are concerned because markets are rising and markets are hitting all-time high at almost every day. And there's genuine concern in the mind of investor that we have seen these kind of situation played out in past as well. And had we have taken money out when the markets was peaking, then perhaps we could have done much better. When the market was coming down, perhaps we could have invested back into the market. So that was the kind of fear people have in their mind, and that is the reason that investors are extremely nervous. So, if you allow me, I can run you through what happened in 92, 2000, and 2008, and why this market of 2023 is very, very different from the market what we witnessed in last three big rallies when the market has corrected more than 50%. So my submission is very simple. The markets are touching all-time high, but we do not see big froth or market in bubbly zone, and we do not see big correction happening to this market the way it happened in 92 or year 2000 or 2008.
Okay. No, please do tell us and try and, Vijay, if you can, give it from a perspective of somebody who's holding holdings in mutual fund schemes. What should her approach be?
So my submission is that suppose you take money out from these levels. For argument's sake, you believe that 64,000 Nifty 19,200 is too much. Then what one should do? Take money out, and what will you do with the money which you've taken out? Will you wait for the correction? At what level you will come? 18,000, 18,500, 17,500, 17,000. Put that level and hard code those level. The market may come to those level as well, but on that day, you will not invest because your past track record of most investors suggests that people who wait for correction end up not investing. If you invested money in the equity market and stay invested, there's a solution to that. If the market come down, the NAV of the fund will come down, your valuation will come down. But eventually market do rises, and when the market rise, your portfolio also go up. But the money which you're not invested, there's no solution to that kind of money. So it is very easy to say that we'll wait for the market to correct, but and we'll invest at that time. But it's very hard to do that because at 19,200 market may look to us overvalued. But suppose you want to go to 18,000 or 17,000 and want to invest at that time, the market may see those level in future, but the news flow will not be of 19,200. The news flow would be of 17,000. We have seen Nifty hitting 18,000 plus 600 number in October, November 2021, and the market corrected to 15,500 in June, July 2022. I do not think many investors were investing at that time because at 15,500, the news flow was of 15,500, not of 19,000. So keep that thing in mind. If you're disciplined enough, take money out, but whatever target you have, start investing at that number. Else, it is just a mere theoretical exercise which have, on the contrary, negative impact on your net wealth.
Okay. Um, Vijay, let's assume that somebody is convinced with the argument of staying invested, in which case there is no quandary per se, right? You continue on the path, somebody would have advised, somebody would have thought through and put the money, allocated the money carefully in either a multi-asset fund or a balance advantage fund or an equity fund and a debt fund separately, as the case may be. So let's assume all of that is done. For somebody who's not quite 100% there and is looking for options, right? How do you design the ideal portfolio? Let's say, I mean, either for somebody who is an existing investor and wants to move, or somebody is just putting in fresh money to work currently. What percent in equity, what percent in debt, what percent in other funds, and also some reasons. The only thing is that I'm leaving a condition of this investor being at an average age between 30 and 40, of average risk appetite, moderate to medium high risk appetite, and wanting to invest across asset classes.
So our submission to any kind of investor is first look at your asset allocation, how much money you would like to put in equities, and how to judge that. There are various formula people give you, but ultimately it is up to every individual to figure out. So one formula is in debt minus your age should be in the equities. The second formula is that you look at next 3 to 5 years of your cash flow needs, your EMI, housing loan, your car loan, your expenses, kids' education, whatever it could be. That money has to be invested in debt and only in debt option. Beyond that, the rest of the money need to go in equity. That is the condition number one. The condition number two, however, the allocation to the equity need to be tempered with the fact that equity market may go down 10, 15, 20% from these level at any point of time. So invest that kind of money on which you are comfortable having a temporary losses of 10 to 20%. Only that kind of money one need to put in pure equity fund. Else, there are alternate available. Investor may look at investing in equity saving schemes. Investor may look at investing in balance advantage fund and multi-asset fund. And in all these three categories, the allocation to equity vary from 10% to maybe 65% to 70%, depend on their ability to absorb temporary losses. They should look at investing that way. That is the one part. Second part, however, I forgot to mention, but it is very important to know that this market of 2023 is not the market of 92 and 2000 and 2008. I will just take few minutes to explain you. In 1992, 1 year return of the equity market was 97%.
Just lost Mr. Vijay Mantri. Maybe a, that's the thing with technology. Maybe a call came or otherwise, but I think we've just lost that window. But I think the point that he was trying to make is that the markets are slightly different than what they were at some point of time in the past. So that's to be kept in mind. Just one thing before we wrap up. Keep in mind the funds that he's recommending. I think those graphics will come up on your screen, wherein for people who want to buy with a minimum 1 year holding period, the ICICI approved All Seasons Bond Fund, the Nippon India Corporate Bond Fund, and the HDFC Corporate Bond Fund, as well as on the other side, the White Oak Multi-Asset Allocation Fund, ICICI approved Balance Advantage Fund, HDFC Balance Advantage Fund, and Kotak Balance Advantage Fund. So you can kind of pick and choose, but I think these are probably all season funds for most investors who cannot do their asset allocation themselves between equity and debt and other asset classes, and therefore a combination like these would help. Well, Vijay, I stole some of your thunder, but maybe we can just wrap it with the point that you were trying to make about how this market is slightly different than what the previous markets were.
So investors need to keep in mind that in 1992, the 1 year return of the equity market was 97%. 3 year return was close to 5.5 times. 5 year return was more than 7 times, and 10 year return of equities in 1992 was 16 and 17 times. So that was 1992. and it was a scam-driven rally. No big institution participated in that time except LIC. If you look at year 2000, it was a market completely driven by TMT. And what kind of return the mutual fund has delivered? The average mutual fund return of 1 year was 73%. 3-year return was more than 300%. In Feb 2000, 1 year return of many mutual fund was more than 3.5 to 4 times. In fact, Franklin India Templeton Technology Fund delivered 4.5 times return in 1 year's time. So that was year 2000. If you look at 2008, what kind of return equity mutual fund has delivered in 2008? In 2008, the preceding 5-year return in equity mutual fund was 50% CAGR. It means the NAV went up 8 times. 10-year return was 34% CAGR. The NAV went up 16 to 17 times. If you look at current return, last 5 years CAGR is 1236 of Nifty, and last 10 years CAGR is 12.5%. Basically, what has happened in last 10 years? Equity market has given you 2.5 times money, which actually is much lower than long-term averages and also lower than absolute expansion in the India GDP. So if you see from any parameter, this market of 2023 is not of 92, 2000 or 2008. So we do not see big correction happening in this market. 5, 10, 15, 20% market correction is normal. I don't think anything beyond is happening. And any investor is scared of investing, do BAF, multi-asset, or whenever the markets are correcting, put money, because long-term journey of India's story is much, much longer and much, much bigger.
Well, those are the words, wise words coming in from Vijai Mantri. I laid out some of the funds that he had mentioned, and they are there in the graphics as well as in the story that we'll do of this show. But, interesting to talk about all of the points that he mentioned, and particularly the comparisons that with Vijai Mantri is given relative to what's happened in the past. Just the fact that the returns have not been as astronomical and therefore, kind of give that comfort. Vijai Mantri, thank you so much for taking the time out and being with us on this leg of the Mutual Fund Show.
Thank you very much, Neeraj, and your team. Thank you very much.
The pleasure was entirely ours, and viewers, thanks for tuning in.